What's up, everybody? Welcome to the life cycle of a trade, the series where we break down the thought process behind trade entry, trade adjustments, and closing order. In this video, we are going to cover an iron fly. I'm looking at a trade that I don't do a ton of, and it's because it's a very slow moving trade, but you really need to be a high volatility underlying for this sort of trade. I'm looking at Palantir, and I'm thinking maybe an iron fly sets up nicely here. So if you look at Palantir, it's a stock that has absolutely exploded to the upside. It's very much has had a lot of social buzz to it, to say the least. I'm looking at this implied volatility of almost 70% implied volatility. When you get into the earnings expiration, which is out in February, you got in the 80 handle implied volatility. So very high implied volatility. Stock has come down a tiny bit. And the biggest issue here for this stock is that it's got a little bit higher margin requirement because of how high that volatility is. If you were to do a strangle here naked, it would use about $2,500 in buying power, which is too big of a position for my account. So for me, I'm going to look to do an iron fly, which is a straddle right at the money, the 70 strike straddle. You can see there's a big credit of $10 and change, but uses a lot of buying power. And then we're going to buy the wings just to cap the amount of buying power that we're using here. We're going to want to reduce this down to, somewhere around $1,000, maybe a little bit less than $1,000 here. So I'm going to go here. I'm going to buy 15-point wide wings. So we're going to look at the 55 strike for the long option on the put side, and we're going to go to the 85 on the call side. You'll see this sets up with a pop that's 42%, and that's because you're buying those wings. Your risk profile is within the expected move here, so it's a lower probability trade, but you're playing into what is a 60 IV rank and almost a 70% implied volatility. So you have a lot of volatility baked into this position. To give you some context, if this underlying were to see a 5 or 10 point drop in volatility, this spread would certainly be profitable, assuming that the stock stays somewhere around this mark here, somewhere inside the expected move, which you would expect if you get a volatility contraction. So we're going to route this at an $8.52 credit. We'll see if we get filled here for this kind of 50-50 high vol play that we're looking for in Palantir. We'll do it at here. Those markets are moving. So I'm going to move this to 8.45. See if we get filled a penny above mid price. We actually got price improved to 8.56 on this iron fly. So we're looking for a move between 60 and 80 over the next 37 days for this to be profitable. We'll see if that happens, but stick around because we're going to do some management on this trade. We've had some two-sided action. The stock has gone from, the 70 handle up to 85. We're back to 75 here. So we've gone $5 in the money on the call side. Of course, no problem with assignment here. Lots of extrinsic value in a stock like this, a high volatility stock, moving stock, a stock that moves a lot day to day. So no issues there. We do have 15 days to go till expiration, which is getting down to the last part of the expiration. You can see we've got about $3 of extrinsic value on this position. The way we can look at that is just by taking the put strike, which is, let's call it about $1.30-ish, and then the in-the-money call strike is actually going to have the same amount of extrinsic value as that out-of-the-money put. So $2.50 or 60 cents is what I have left to make on this position if the stock stays right where it is. And the stock has actually rallied significantly in the last hour or so. When I was looking at this position, you could see we moved from 73 to 75. I'm looking at my P&L values, and we were looking at about $120 profit at the early part of the session this morning, but that has since eroded a little bit, but still doesn't take away from the message here. So anyway, with 15 days to go till expiration, the decision now is to either close the position or roll into either the same position in the further out expiration or a new position. You could go to do multiple different things here. For me, I think it's just a close, take some money and run on this position. It's one that when we got up to 85, which was basically the high of the year, 84.80, This was a losing position. Now we've had a little bit of a pullback. We're making some money on the position. I think it's time to just take the profits and move on to another position. So to close out of this position, one of the things that I make sure I look at is to make sure there's a bid and an ask on the long options. If there isn't, you want to just remove those options from the closing order because they have no value, but there is value in these, about 8 or 9 cents on the downside. So if we can get filled here for a little bit less than the mid price, let's see if we can get 85-cent profit here, which would be $7.61 fill price on this. Don't fill there. Go up to 65. We'll fill there, and you'll see that within the money options, there we go. We got filled as we were talking, but in the money options, you'll see your bid-ask spread be much wider than the out of the money options, and thus, it makes it hard to fill. You might have to adjust the price a little bit above or below the mid price, depending on if you're buying or selling. So anyway, we routed that closing order $7.65 debit, nets us out an $81 profit. But really the key here was that we had a little bit of a sideways move here, or at least ended up as a sideways move throughout the duration of the trade.